Welcome to all. Today we are going to learn about security valuation, presented by Dr. Sridevi. Introduction. The task of the present topic is to explore basic factors that affect all investment values. It first draws a framework which gives the various approaches to investments and then discusses the valuation models. The study of investment is concerned with the purchase and sale of financial assets and the attempt of the investor to make logical decisions about the various alternatives in order to earn returns on them. The returns are further dependent on the varying degrees of risk. A financial definition as defined by Amling is investment may be defined as the purchase by an individual or institutional investor of a financial or real asset that produces a return proportional to the risk assumed some future investment period. Another definition is also given by Fisher and Jordan. It describes an investment as a commitment of funds made in the expectation of some positive rate of return. If the investment is properly undertaken, the return will be commensurate with the risk the investor assumes. The mentioned definitions of investment bring forth three elements of investments categorized as return, relationship of return and risk, and time factor. Return is the one of the elements of investment. It gives the meaning of investors may buy or sell financial assets in order to earn returns on them. The returns, better known as rewards from investments, include both current income and capital gains or losses which arise by the increase or decrease of the security prices. The capital gains or the income earned are then treated as a percentage of the beginning investment. Returns therefore may be expressed as the total annual income and capital gain as a percentage of investment. Satisfactory return are different for different people. Two rational investors may be satisfied by different levels of anticipated returns and estimated risk. Rational investors like returns but are risk adverse. They try to maximize their utility by buying, holding, or adjusting their portfolio to achieve maximum utility. Return, in other words, is the yield on the security. Yield of the stock will be price of the stock divided into current dividend. This is known as current yields. There is no compounding of returns. The annual capital gains are included on the stock price to find out their returns. For example, if an investor receives rupees 2 per share in dividends and earns rupees 3 per share per year in capital gains and has an average investment of rupees 20, the return on the stock would be 25%. While return in stock is not related to a maturity date in bond investments, the maturity date is very important. Yield is the compound rate of return on the purchase price and the bond over its life. This is referred to as yield to maturity. Return therefore includes interest and capital gains or losses. Stock yields and bond yields should be carefully compared since measures are different. Methods of measurement of returns are presented in the topic as well as in the next topic. The next elements of investment is risk and return. Risk and return are inseparable. To ignore risk and only expect return is an outdated approach to investments. The investment proposals must be considered in terms of both the aspects, risk as well as return. Return is a statistical term. It is not a simple expectation of investors' return, but it measurable also. Risk is not a statistical term, but we use statistical terms to qualify it. The investor should keep the risk associated with the return proportional as risk is directly correlated with return. It is generally believed that higher the risk, the greater the reward, but seeking risk does not ensure the return. At a given level of return, each security has a different degree of risk. The entire process of estimating risk and return for individual securities is known as security analysis. The last element of investment is time factor. Time is an important factor in investment. Time offers several different courses of action. It may be involved and range from trading to buy and selling at a major turning points in the market. It may also consider the time period of investment such as long term, intermediate or short term. Time period depends on the attitude of the investor. As investments are examined over the time period, expected risk and return are also measured. The investor usually selects a time period and return that meet expectations of return and risk. Since equity should be considered, the investor can follow a buy and hold policy and analyze to make successful decision during the longer term framework. Some professional analysts think that 3-year period are best to analyze stocks and bonds as it is long enough to eliminate the efforts of business and market cycle on security prices. Such a period is also just right to achieve economic results from new products, new developments and also new ideas. As time moves on, analysts believe that conditions change and investors re-evaluate expected return and risk for each investment. The management of investment is thus a complex study of maximizing return. It is also separated into two parts. First one, security analysis. The security analysis is a traditional method which helps to analyze emphasize the project of prices and dividends. Accordingly, the potential price of a firm's common stock and the future dividend stream were to be forecast and then discounted back to the present. The next one is portfolio management. Portfolios are combinations of assets. Traditionally, portfolio management was the selection of securities to suit the particular requirements of an asset. The last one is modern portfolio theory. It is based on the scientific approach and has scientific applications based on estimates of risk and return of the portfolio and the attitudes of investors towards a risk return trade-off through analysis and screening of individual securities. The return of the portfolio is based on weights of the percentage composition of the portfolio.